Hi students, welcome back to Google Classroom Sri Gokulam Public School, Guruvayur. How are you children? Hope you all are fine over there.
In the previous class, we have discussed three important sources of business finance. They are factoring, lease financing and public deposits. Hope you learned that portions. Today we will discuss another two important sources of business finance. They are commercial paper and issue of shares. At first, we will discuss what is commercial papers and its main merits and limitations also. Commercial paper is an unsecured promissory note issued by a firm to raise funds for a short period, varying from 90 days to 364 days. It is issued by one firm to other business firms, insurance companies, pension funds and banks. When compared to other sources like bank loans and loans from other financial institutions, commercial papers can provide more funding at a lower interest rate. And it is usually an unsecured debt, where the company doesn't pledge any asset, but it still qualifies for it based on their company's liquidity, revenue generating power and achievements. Then let's discuss the main merits of commercial paper. A commercial paper is sold on an unsecured basis and it does not contain any restrictive conditions. As it is a freely transferable instrument, it has high liquidity. When compared to other sources like bank loans and loans from other financial institutions, commercial papers can provide more funds. And the cost of commercial paper to the issuing firm is lower than the cost of commercial bank loans. And commercial paper also provides a continuous source of funds. This is because their maturity can be tailored to suit the needs of the issuing firm. Besides, maturing commercial paper can be repaid by selling a new commercial paper. And the companies can serve their excess funds in commercial paper and also earn some good return on the same. So these are the main merits of commercial paper. Then let's discuss the main limitations of commercial paper. The first one is only financially sound or secure and highly rated firms can raise money through commercial papers, because new and moderately rated firms are not in a position to raise funds by this method. And the next one is the amount of money that can be raised through commercial paper is limited. And the next limitation is if a firm is not in a position to redeem its paper due to financial difficulties, extending the maturity or duration of a commercial paper is not possible. So these are the main limitations of commercial paper. Now we will move on to the next source of business finance, that is issue of shares. First of all, you have to know what are shares. Share is the smallest unit into which the total capital of the company is divided. For example, when a company decides to raise rupees 50 crores of capital from the public by issuing shares, then it can be divided its capital into units of a definite value, say rupees 10 or rupees 100 each. These individual units are called as its share, and the capital obtained by issue of shares is known as share capital. And the investors who have purchased the shares or invested money in the shares are called shareholders. In simple terms, we can say the person holding the share is known as shareholder, and they get dividend as return on their investment. And there are two types of shares normally issued by a company: equity shares and preference shares. The money raised by issue of equity shares is called equity share capital, while the money raised by issue of preference shares is called preference share capital. Then let's discuss what is a equity share and its main merits and limitations also. Equity share is the most important source of raising long-term capital by a company, and the equity shareholders are the owners of the company. That means these shares represent the ownership of a company, and they do not get a fixed dividend but are paid on the basis of earnings by the company. That means there is uncertainty of return on equity shares, as there is no guarantee of payment of dividend. In case of profit, the company may pay dividend on equity shares after the payment of dividend on preference shares. And at the same time, the rate of dividend on equity shares is not fixed in advance. It depends on the volume of profit earned by the company. From this, we can understand equity shareholders enjoy the reward as well as bear the risk of ownership. And the liability of equity shareholders is limited to the extent of capital contributed by them in the company. And the most important feature of equity shareholders is that they have a right to participate in the management of the company. Then let's discuss the main merits of equity shares. Equity shares are suitable for investors who are willing to assume risk for higher returns. We already discussed that the rate of dividend on equity shares is not fixed in advance. It depends on the volume of profit earned by the company. Therefore, in practice, the rate of dividend fluctuates between no payment of dividend and payment of 100% or more dividend. And the next merit from the management point of view is that payment of dividend to the equity shareholders is not compulsory. That means there is no binding on the company to pay dividend on equity shares. The company may declare dividend only if there are enough profits. And the equity capital serve as a permanent capital because the capital raised by issuing equity shares is not required to be paid back during the lifetime of the company, and it will be paid back only when the company is winding up. And equity capital also provides creditworthiness to the company, because if a company raises more capital by issuing equity shares, it leads to greater confidence among the creditors. And the next merit is the funds can be raised through equity issue without creating any charge on the assets of the company. And the most important advantage of equity shares is that democratic control over the management of the company is assured due to the voting rights of equity shareholders. So these are the main merits of equity shares. Then let's discuss the main limitations of equity shares. Investors who want steady income may not prefer equity shares because equity shareholders get dividend only when the company earns sufficient profits. The decision to declare dividend lies with the board of directors of the company. And the next limitation is the cost of equity shares is generally more as compared to the cost of raising funds through other sources. And issue of additional equity shares dilutes the voting power and earnings of existing equity shareholders. As the equity shareholders carry voting rights, groups are formed to grab the control of the company. This may lead to conflicts of interest, which is harmful for the smooth functioning of a company. And the last limitation is more formalities and procedural delays are involved while raising funds through issue of equity shares. These are the main limitations of equity shares.
So students, I hope all of you understood the concept clearly. And please note that the notes of the lesson and test paper are also attached along with the class. Make use of these available materials. Study well and attend the test paper without fail. That's all for today. Thank you.